Hello everyone, my name is Matthias and welcome to my channel. Today I'm gonna tell you why I purchased shares of Amazon. My thesis does not rest on AWS revenue reacceleration, nor does it rest on margin expansions because of their robotics arm. My thesis rests on a very simple understanding of the long-term value creation processes that allows Amazon to grow durably and sustainably for a very long time, these being scale economies shared. Now, before we head into this video, this is in no way, shape, or form financial advice. I'm no financial advisor. I'm just a random guy on the internet expressing his opinions. Now, as I mentioned, I initiated a position in Amazon, making it a 7.2% position. Obviously, I want to increase this position, making it a core holding in my portfolio. As I mentioned, I see this company growing durably and sustainably for a very long time, and we're gonna take a look at why I think this is the case. In order to do so, I'm gonna read some excerpts from this book, Sam Walton's Made in America, and also compare it to some of the excerpts from Jeff Bezos' annual shareholder letters. This is in order to qualitatively understand the core value creation processes of these companies, thinking small, which then in turn allows them to spin this flywheel of scale economies shared. This is a very famous picture of the Costco flywheel. Amazon and Walmart operates with the same flywheel. Very basically, it can be understood as increased scale allows you to lower prices. Taking a bit more advanced steps into it, we can see that these lower prices slash better value proposition gives them an increased scale and efficiency. Because you have lower prices, that attracts a lot of more customers to your platform, which then increases your scale. Now you can lower the costs per dollar of revenue. It becomes cheaper of you to operate your platform, to operate your company, which then allows you to run those cost savings back to your customers. Cost savings returned. Now this is the core element of the scale economies shared thesis, which is the core value creation element of Amazon, Costco, and Walmart. As I did mention previously, my thesis doesn't hinge on any margin expansion through their robotics arm. Now, this is based on the simple fact that Amazon will probably use those margin expansions to lower their prices. They will probably allow these higher margins gained from their robotics, gained from these efficiencies, to pass those savings back to the customer through cheaper prices on AWS, Amazon Fulfillment, their first-party seller services, increasing the service on the third-party seller services, and so on and so forth. I don't think we'll get the free cash flow returns from Amazon because of these margin expansions, but these margin expansions will allow them to lower prices, thus increasing volume on their website, on their AWS services, and so on. This is my only point of contention with the consensus Amazon thesis. As mentioned, I don't think we'll see the free cash flow directly from those margin expansions. Shortly said, and I'll repeat myself, I think we'll see it because of higher volumes. It'll allow them to basically lower their prices. So why did I wait until now? I've known for a long time that Amazon is a wonderful company. I've known for a long time that Amazon is among the greatest companies in the world. Now, at a price of $232 a share, I initiated my position. Is it because I know something that the market doesn't know? Is it because I have some knowledge about Amazon that everybody else doesn't have? My basic answer is no. I don't know anything that the market doesn't know. The thing I think I have grasped to a higher degree and to a higher level is just how sustainably and how much Amazon can scale their business. I think Amazon has the potential to reach infinite scale. They have all white space in the world to grow into. And this is because if you understand this company qualitatively, you would know that this is a company that just keeps on spawning verticals. It is also a company that through good and bad times is able to increase their revenue consistently, which allows them to basically create more verticals. It's not the case that I know something that the market doesn't. I think after having read this book, Taking a more qualitative approach, I think I have finally understood just how much Amazon can actually grow. What made this click for me was reading this book, and there's a point where Sam Walton said that after having 9 stores in Arkansas, he didn't think and he didn't want to manage any more stores. He was afraid that it couldn't keep on scaling. He didn't want it to scale any further. But needless to say, Walmart continued scaling because of this core element of cost savings passed on to the customer, delighting the customer. This basic understanding and this model allows a company to grow so durably and so sustainably. I thought it was hilarious to hear that after having 9 stores, he didn't want to open more. This picture is an excerpt from the book. I took this picture from the book to just sort of visualize this growth. In 1960, they had 9 stores, and in 1990, they had 1,528 stores, also growing and scaling their sales and profits along the way. I think it is a very, very interesting way to think about this sort of company, that they have just so much space to grow into. They have such infinite scale to grow into. A specific element in order to understand the value creation is this idea Sam Walton presents of thinking small, which is something that I also think Jeff Bezos applied in building Amazon into the powerhouse that it is today. Very simply, the thing that Sam Walton said allowed Walmart to scale to such a degree was their ability to think small. He specifically said that the bigger Walmart gets, the more essential it is that we think small, because that's exactly how we've become a huge corporation, by not acting like one. Amazon does this very thing. They lower prices for shipping, they lower prices for AWS. In other words, they keep on thinking and acting like they're a small company. This idea of thinking small allows you to please your customers, allows you to pass savings on to the customers, and keep on growing through this virtue. Sam Walton says, because our sales and earnings keep going up doesn't mean that we're smarter than everyone else. What it means is that our customers are supporting us. If they stopped, our earnings would simply disappear and we'll all be out looking for new jobs. So we know what we have to do. Keep lowering our prices, keep improving our service, and keep making things better for the people who shop at our stores. This is something that Jeff Bezos is fanatic about. Now, what I've marked out here is from their 2020 annual shareholder letter, where Jeff Bezos says that it remains day one. This is Jeff Bezos applying the thinking small framework. Another very interesting element of his way of thinking is this idea of fearing the customer. Specifically, Jeff Bezos said, but there's no rest for the weary. I constantly remind our employees to be afraid, to wake up every morning terrified, not of our competition, but of our customers. Our customers have made our business what it is. They are the ones with whom we have a relationship, and they are the ones to whom we owe a great obligation. And we consider them to be loyal to us, right up until the moment that someone else offers them a better service. This idea of lowering prices, this idea of passing savings on to customers, is something central to the Amazon thesis. Jeff Bezos in 2015 shareholder letter wrote that our approach to pricing is also driven by our customer-centric culture. We've dropped prices 51 times in many cases before there was any competitive pressure to do so. This is on AWS. Now, this is this part of the Costco flywheel applied to Amazon. This idea of sustainably growing through the long term by pleasing customers, by being customer centric, is a core element of my Amazon thesis. And this is something that, in my opinion, allows Amazon to grow so sustainably. This is something that allows Amazon to keep on scaling in the same way that Costco did, and in the same way that Walmart did. Now, I obviously know that Amazon is a huge company. It is much bigger. It has incredibly high revenues. But I still think, as Jeff Bezos says, that this remains day one for Amazon simply by the virtues of their cost savings returned. They can grow for such a long time. They have the scale to please their customers. This series of articles from Sarah Tavel is incredible to apply and use on marketplaces and platform companies. Basically, the point of this article is to sell that the thing that drives revenues, the thing that drives value for these for these marketplace companies, is basically their ability to cause and create happiness for their customers. She has a very interesting quote down here. Marketplaces that are able to scale the hierarchy build dominant winner take most value. This is obviously the case in e-commerce for Amazon. They have created massive distance between number one and number two. I wouldn't even be able to tell you who's the number two e-commerce provider in America, but obviously I know that that Amazon is number one and by a huge margin. She basically says that what is required to getting to the winner take most value position is not a focus on GMV, the gross merchandise volume, but on creating happiness. This is something that is central to Jeff Bezos' understanding of marketplaces and creating Amazon. I just showed you that he focused on building a customer centric culture, fearing the customer, creating happiness, creating value. Obviously, he focuses more on creating happiness than on raising GMV. Why would you make it possible for customers to read negative reviews on your platform? This was something that was very highly contested in the early days of Amazon. Why would people buy a book if they could see that it was a terrible book? Why would you allow for product reviews? This could hurt revenues in the beginning, but create long-term trust. Of course, also, why would you allow third parties to sell on your platform? Why would you allow third parties to compete directly with you on your platform? This will hurt your revenues, but obviously, it has created massive value for Amazon in the long term. This innate focus and drive to focus on customer happiness and positive customer outcomes is what has driven Amazon's value creation in the long term, is what allows it to sustainably keep growing in the future, why they do have infinite scale. So, as Sarah says here, in other words, happiness, not scale, is your moat. Going back to the Costco flywheel, what allows you to get here to the cost savings return is your scale. But what allows you to scale is your ability to create happiness. What allows you to create happiness is your lower prices and the better value proposition. It's right here. The whole flywheel starts with better customer outcomes. It starts with happiness, not a focus on GMV. Few platforms choose to focus on happiness before they focus on GMV and revenues. Few companies are willing to make those sacrifices, and Amazon is among those. A very central element in Jeff Bezos' shareholder letters is this idea of sacrificing short term gap Wall Street bullshit for long term gains, for long term free cash flows. They're willing to sacrifice all this Wall Street bullshit in order to increase their cash flows over time. How do they do this? By creating happiness, by having lower prices and better value propositions. This is very central to my understanding of Amazon's value creation processes. I hope that you guys now understand why I think Amazon has such scaling potential. They have such scalability. They are able to grow because they pass those savings back to the customers, which makes for more happy customers, which leads customers to refer their friends, which leads customers to keep on purchasing on their platforms. Now, this allows these new customers to save, which then allows Amazon to make more revenues, and then they'll keep passing on those savings back to the customers. This makes for a very virtuous cycle and a lot of long-term value creation. So in this final part of the video, I would like to present why making valuation and why running valuation models on Amazon through their free cash flow is such a misleading process, why you would never be able to capture the full value creation by looking at their short-term free cash flows, and why that is misleading. So let's hop into this final part of the video. Applying this discounted free cash flow model with a terminal growth rate of 3%, a discount rate of 10%, it says that Amazon has to grow its free cash flow by 24% compounded for the next 10 years. Of course, this is a very tall task to ask for, and if you use this framework, if you look and take an isolated look on their free cash flow for 2024, $32 billion, this would make you look crazy if you say that Amazon could sustainably grow their free cash flow for 10 years by 24%. Now we can talk about how representative their free cash flow is of their actual earning powers. Amazon is a capex heavy company that plows every dollar they earn back into the company itself for it to continue to grow. This is also a very interesting part of the Amazon value proposition. They don't pass on their free cash flow to their investors. They keep on investing into their own growth. We can see them doing it now with AWS. With every extra part of capacity they add, they're able to sell. We saw it previously with them investing heavily into their logistics network, and we're gonna see them continue doing so for a very long time. Obviously, using these free cash flow numbers could be misleading in order to sort of capture the value creation and what creates value for you as a long-term shareholder of Amazon. You would look crazy if you said that Amazon could compound its free cash flow for 25-4% the next couple of years. Now, what you could do is subtract the capital expenditures, but add back in the maintenance capex for those data centers in order to get a more fair view of what they could pass on back to you. But this still doesn't capture the value creation process of Amazon. Let's take a look at their long-term free cash flow, and I bet you that regardless of when you would have run a reverse discounted cash flow model or just a discounted cash flow model, this would make you look crazy. You would never be able to justify purchasing Amazon, which means regardless of the price you paid, it wouldn't make sense for the cash flows distributable back to you. This also doesn't capture the full value creation process for Amazon. The idea I'm trying to present to you is whenever you would have performed a DCF or a reverse DCF model on Amazon to gauge their ability to pass back free cash flow back to you, you would look stupid. You would look crazy trying to justify the high cash flow returns. But my point is that Amazon can grow sustainably, keep on scaling sustainably for a very, very long time. Also, just looking at their free cash flow doesn't present what actually creates value for you as an investor. We've seen that what creates value for their customers is their scale economies shared. In my opinion, a more optimal way of gauging Amazon's value creation for you as an investor is their ability to spend their operating cash flow wisely. Now, what I mean is wise management of their operating cash flow. How well do they do their capex expenditures? How well do they invest back into the company? We've seen from now and from looking back at Amazon in the long term, they have been perfect and impeccable at using their money wisely. Going back to Qualtron, we can look at their revenue by segments to sort of gauge this. Now, obviously, if you qualitatively look at Amazon, it started out as a bookstore. It started out as a website for buying books. Then they added music. Then they added DVDs. Then they added bikes and so on and so on and so forth. Then they added fulfillment by Amazon. Then they added Prime. Then they added AWS. Then they added the Kindle. Then they added everything that came after that. Now they've added advertising, which is also an increasing part of the value creation for Amazon. They've added subscription services. They've added all these fantastic parts of their business. Gauging this and taking a look at their operating cash flow, how wisely they spend it in order to create new verticals, in order to create new avenues of growth for you as an investor, is where Amazon creates the value. This is what you should be looking at. You would never be able to justify paying up for Amazon by just gauging their short-term free cash flow. Obviously, you would get it back in the long term, right? But what my point is that you would look stupid if you try to justify buying Amazon by using a discounted cash flow model. which is usually how a lot of investors tend to look at these things. But then they miss the value creation, which is their ability to scale their company, which is their ability to just keep on spawning these new verticals. Also, there's a very, very simple way of gauging this. So the valuation, running a valuation on Amazon is basically impossible. It's basically impossible to fully capture the value that they could pass back to you because they spend a lot of their operating cash flow, they spend a lot of the money that they earn on the improvement of their company, right? That's what they do. That's what you should just get used to as an Amazon investor. But there's a very simple way of gauging whether Amazon is a good company to buy, and I'm gonna go back to the 2000 annual shareholder letter from Jeff Bezos. So this is a letter where Bezos reflects on the 2000 stock market crash with the internet bubble, and he says that the company is better positioned today than it was a year ago. So why is the stock price so much lower than it was a year ago? As famed investor Benjamin Graham said, in the short term, the stock market is a voting machine, and in the long term, it is a weighing machine. Clearly, there was a lot of voting going on in the boom year of 99, and much less weighing. We're a company that wants to be weighed over the long term, and we will be. Over the long term, all companies are. In the meantime, we have our heads down working to build a heavier and heavier company. Going back to their ability to scale and keep on adding verticals to their company. Going back to their ability to keep on lowering prices, increasing volume for their customers is the elements, and these are the elements that cause the value creation for Amazon. Their ability to basically build a heavier company over time. Gauging their free cash flow, running valuation models on them doesn't capture this. Using the idea of how well they manage their operating cash flow is a much more optimal way, in my opinion. Now, obviously, this could be flawed. Obviously, I could have overlooked things in my analysis. Obviously, I could be wrong. So that's why this is not financial advice. This is just my opinion. So that was it for me today, guys. Basically, it all goes back to this idea of thinking small based on Sam Walton, this brilliant, brilliant man. Um, so yeah, they're basically what I'm trying to get at is Amazon is an incredible company, and I'm very happy to be part of this journey. And I hope that you guys enjoyed watching. Now, if you enjoy this English version of my videos, usually I do videos in Danish, but if my Danish audience likes these English videos, I will keep on making English videos. I hope you guys enjoyed. Thank you for watching, and I'll see you next time.